Ever wondered how businesses raise billions of dollars to fuel their growth, or how you, as an investor, can be part of this financial journey? It's a world that seems shrouded in mystery, filled with acronyms like IPOs and ICOs. But what do they mean? How do they work? And most importantly, how can they affect your financial future? These are the million-dollar questions we're about to tackle. Stick around as we unravel the mystery of IPOs and ICOs. First off, let's tackle IPOs. That's short for initial public offering. So, what's an IPO? It's when a private company decides to sell its shares to the public for the very first time. Think of it as a debutante ball, but for businesses, their grand introduction to the world of public trading. Now, this isn't a spur-of-the-moment decision. It requires meticulous planning and execution. First, the company hires investment banks to underwrite the IPO. They work together to determine the number of shares to be issued and at what price. Once that's settled, they file the necessary paperwork with the Securities and Exchange Commission. It's a bit like sending out the invitations to that debutante ball we talked about. Then comes the roadshow, where the company's top brass pitches to potential investors. It's their chance to impress, to showcase their potential. Once the roadshow wraps up, the final offer price is set, and voila, the shares are listed on a stock exchange for everyone to buy. Take the recent examples of Airbnb or Uber. They started as private companies, but through their IPOs, they've become part of the portfolios of millions of investors worldwide. But remember, as with all investments, IPOs come with their own set of risks. Sure, they can offer substantial returns, but they can also lead to significant losses. It's about balancing the potential for profit with the risk of loss. IPOs can be a golden ticket for businesses and investors alike, but they're not the only game in town. Now, let's shift our focus to ICOs, or initial coin offerings. Much like its traditional counterpart, the initial public offering, an ICO is a fundraising mechanism, but it's used predominantly by startups working with blockchain technology. Instead of issuing shares of a company, they offer their own cryptocurrency to investors. How does it work? Well, it's a bit like a digital version of panning for gold. A company creates its own digital currency and sells a portion of that currency to early backers, typically in exchange for other cryptocurrencies like Bitcoin or Ethereum. These early backers are essentially betting that the currency they just bought will increase in value over time. Launching an ICO is a bit like launching a rocket into space. It requires a solid plan, a dedicated team, and a lot of hard work. The company needs to create a white paper outlining the project details, the need it will fulfill, how much money is needed, what type of currency will be accepted, and how long the ICO will run for. Some examples of successful ICOs include Ethereum, which raised over $18 million in 2014, and more recently, Filecoin, which raised over $200 million in 2017. But remember, just like the gold rush of the 19th century, there's potential for great reward and great risk. While ICOs may seem like the Wild West of investing, they can offer a unique opportunity for those willing to venture into the unknown. So IPOs and ICOs, two different paths to raising capital. But which one is better? A question that's been stirring up quite the storm in the financial world. Let's dive into it. On one hand, you have initial public offerings, or IPOs, the traditional method that's been around for centuries. IPOs are often perceived as a sign of maturity and stability, offering a sense of security to investors. They also provide a company with the ability to raise a substantial amount of capital. However, the process is complex, time-consuming, and often costly. Regulations are stringent and the company's financials are laid bare for all to see, which can be a deterrent for some. On the flip side, you have initial coin offerings, or ICOs, the new kids on the block. ICOs offer an innovative, high-tech approach to raising capital. They are faster, more efficient, and less regulated than IPOs. They provide a global platform for companies to raise funds and for investors to participate, but they also come with their own set of challenges. The market is highly volatile and the lack of regulation leaves room for potential fraud. So, which is better? Well, that depends on the individual business and investor. Both have their merits and drawbacks and cater to different needs and risk appetites. Whether you choose the traditional route of an IPO or the high-tech path of an ICO, the key is to stay informed and make wise decisions. And remember, every investment carries its own risks and rewards.